your unlevered cash flow is always going to be greater than your levered cash flow. Now let's take a look at a side-by-side comparison of these two elements. So here we have the free cash flow to the firm and we have the free cash flow to equity. And the first thing that jumps out to us is our starting point. Well, the free cash flow to the firm calculation starts with earnings before interest and taxes, and we see that that number is $420 million. And then we take a look at the free cash flow to equity, and that's based on the net income of the company. And in this example, that net income would be $251,400,000. Then we take into consideration taxes on the free cash flow to the firm. And in our example here, we have a tax rate of 28%, and we back out that tax payment of $117.6 million. Notice on the free cash flow to equity, we do not have an entry for taxes because the first entry on the free cash flow to equity calculation is that net income. Taxes have already been taken into consideration. So the next element here is to add back depreciation of $90 million in this example. Now moving back over to the free cash flow of the firm, we have to take into consideration our net capex as our capital expenditures minus depreciation. And we had in this example $150 million in capex and $90 million of depreciation. Therefore, our net capex is $60 million, and we back that out. Over on the free cash flow to equity, we subtract out or take out gross capex of $150 million. In both examples, we have a decrease in working capital of $31 million, and that's added back to both the free cash flow to the firm and free cash flow to equity. And we realize that the free cash flow to the firm is $273,400,000, and the free cash flow to equity is $222,400,000.